Okay, let's dive right into this fascinating look at how we actually build economic resilience. And we're going to cover everything here, from your everyday household budget all the way up to massive international macroeconomics. Welcome to today's Explainer, where we're going to dissect the exact mechanisms that keep economies afloat when the waters get incredibly choppy. We're looking at some brand new domestic policies right here in the United States, as well as some huge international investments, just to see exactly how these financial defenses are built in the real world.
So here's our roadmap for today's Explainer. 1. Understanding fiscal stress. 2. The public finance lens. 3. America's new 530A accounts. 4. Strategies for employers. And 5. Boosting Sri Lanka's economy. Let's get into it.
Section 1. Understanding fiscal stress. Defining the core economic challenge.
To really get this, we have to start with the academic bedrock. This goes back to Sarah Arnott's 2011 research. Her dissertation, Fiscal Stress in the U.S. States, is basically the vital framework we use to understand the symptoms of an economy that is under intense strain. Because, let's be honest, before we can even think about building resilience, we absolutely have to know how to measure the stress itself.
The crucial takeaway here is that fiscal stress is, essentially, a severe squeeze on the budget. Recognizing that squeeze is the very first step to building defenses against it. Whether you're talking about a state government staring down a massive revenue shortfall or just a regular household trying to navigate an unexpected crisis, fiscal stress always forces difficult choices and really tough cutbacks. So, building resilience, it's all about preparing for that squeeze well before it actually happens.
Section 2. The public finance lens. Academic strategies for budget stabilization.
Now, if we look at the extensive public finance research of Syracuse University Professor Yilin Hu, we see that building resilience isn't just guesswork, it's a deep, measurable science. If you focus specifically on budget stabilization, Professor Hu looks heavily at something called countercyclical fiscal policy. I know, it's a highly technical term, but it's basically just asking, what mechanisms can we put in place right now that actively push back against the downward spiral of an economic bust? Basically, how do we hoard our reserves during the really good times so we can deploy them during the bad?
And Professor Howe's question here perfectly frames our next step. How exactly do we smooth out those financial busts using modern policy and investing? How do we take the absolute peaks of an economic boom and use them to fill in the dark valleys of a recession? I want you to keep this concept of smoothing revenue in the back of your mind, because it literally applies to everything we're about to discuss, starting right down at the individual household level.
Section 3. America's new 530A accounts. Domestic household resilience.
Okay, so right now in the U.S., we are seeing a remarkably rapid rollout of 530A accounts. You'll often hear these officially dubbed Trump accounts, after the legislation that created them, the One Big Beautiful Bill Act of 2025. The whole goal here is to create a brand new generation of capitalists by getting young Americans invested directly in broad stock market indexes. And what's wild is the private sector momentum behind this. In December 2025, Michael and Susan Dell announced a staggering $6.25 billion donation. That money is meant to fund accounts for up to 25 million older kids who unfortunately missed out on the initial government seat money. And as of July 2026, the gates are completely open for deposits.
Now, at the core of this policy is a $5,000 maximum annual private contribution limit per child. Think of it like a stack. This private cap stacks right on top of the initial $1,000 government seed money for newborns, or on top of those $250 private grants from donors like the Dells. The funds themselves are invested in low-cost mutual funds or ETFs that track broad market indexes, like the S&P 500, with extremely low expense ratios. So it's totally designed for passive, long-term growth. No day trading here.
But here is where the long-term resilience aspect really kicks in. It relies on a super strict lockup period. The money cannot be withdrawn before the child turns 18. By strictly walling off these funds throughout their entire childhood, the policy enforces that revenue smoothing concept we just talked about over an 18-year horizon. It essentially forces compound interest to work its magic, creating a massive financial buffer for that young adult right when they finally enter the workforce.
Section 4. Strategies for employers. Integrating 530A into employee benefits.
So what does this mean for employers? Well, contributing up to $2,500 per employee requires navigating some very specific administrative hoops. You're looking at setting up a formal TRIMP account contribution plan, a TAC, or amending an existing Section 125 cafeteria plan. And the incentive to do this is absolutely massive. Employers can use these tax-free contributions as a major bargaining chip in a super competitive job market. But slight catch, they do have to wait for final guidance from the Department of Labor regarding strict ERISA rules. Those are the federal laws that govern employee benefit plans.
This comparison is super interesting. Unlike 529 plans, which give you tax-free withdrawals but specifically only for education, 530A accounts tax the earnings upon withdrawal as ordinary income. However, they offer total flexibility on how the money is spent. It doesn't have to be used for college at all. Once the kid turns 18, it's essentially treated like a traditional IRA. You've got your early withdrawal penalties, sure, unless you use it for specific exceptions like a first-time home purchase. It's really just a completely different flavor of financial resilience.
But this brings up a huge question for human resources. Because these accounts explicitly target children, HR managers have to deeply consider how to ensure benefit equality across their entire workforce, right? Like, if you are funding accounts for the parents on your team, what about everyone else? Well, experts are suggesting funding cafeteria plans with flat dollar amounts so non-parents don't feel left out. That way, they can route their flat dollar benefit into other areas, ensuring the whole team actually feels the financial support of the organization.
Section 5. Boosting Sri Lanka's Economy. International Macro Resilience. Okay, let's pivot from individual domestic capital growth and look at some macro institutional resilience. We are currently looking at a massive $166 million investment from the International Finance Corporation, which is a member of the World Bank Group, directly into 3 of Sri Lanka's leading private banks. They are deploying an $80 million risk-sharing facility where the IFC actually absorbs 50% of the principal losses on eligible loans. On top of that, they're injecting $50 million in direct debt investment, plus providing $36 million in global trade finance guarantees. This is a highly calculated, precise injection of capital designed to stabilize an entire national banking ecosystem.
So why is this massive intervention happening right now? Well, that 4.0% number is the Asian Development Bank's projected moderating GDP growth for Sri Lanka in 2026. After a couple of years cruising at around 5%, growth is officially slowing down. And this slowdown is driven heavily by severe external shocks, which is exactly the definition of fiscal stress we talked about at the beginning of this explainer. Specifically, they're dealing with the ripple effects of the Middle East conflict on energy and trade, combined with the devastating local impact of Cyclone Detwa. Sri Lanka's economy is under severe pressure.
To combat that slowing growth, this IFC funding isn't just a blank check. It's laser-focused on the undisputed backbone of the economy, small and medium-sized enterprises, or SMEs. SMEs make up over 75% of all Sri Lankan businesses and provide 45% of the jobs. So they are targeting the money where it counts. They've earmarked $7.5 million specifically for women-owned businesses. They are heavily backing the incredibly crucial agribusiness sector, and they're funding the modernization of digital transaction systems just so these businesses can operate more efficiently day to day.
And this brings us full circle. By de-risking loans and expanding trade finance, international institutions are providing the exact type of budget stabilization that academics like Professor Yulin Ho study. Remember countercyclical fiscal policy from earlier? This is literally what it looks like in practice on a global scale. When a crisis hits, private capital naturally gets scared and pulls back, right? That causes the economic valley to dip even lower. But institutions like the IFC step in precisely at that moment, pushing capital into the market against the downward cycle, helping businesses withstand the shocks and ultimately rebound faster. So whether it's leveraging tax code changes in the U.S. to build a buffer for the next generation, or supporting global supply chains through targeted risk sharing in Sri Lanka, the blueprint for funding the future absolutely requires proactive planning today. You've seen the academic theory, and now you've seen the practice in the real world. So the question isn't whether the next economic storm is coming, because it definitely is. The real question is, what exact bricks are you laying down today to ensure your walls actually hold when the water rises? Thanks for joining me on this explainer, and keep building that resilience.